Chris, this is a technique of sharing some insurance concepts with you in a way that you can just look at them whenever you want to at your leisure. There'll be bite-sized bits, maybe 5 to 10 minutes max. You can even watch them at work if you're on your cell phone, whatever. So I'm going to share my screen with you. And what the concept for today is just really what is risk. There's two things about it. One is there's two types of risks they'll talk about: pure risk, speculative risk. They'll ask you if speculative risk can be insured or pure risk can be insured. So only pure risk can be insured, and pure risk is a risk that you both have the chance of losing or gaining, like car insurance, house losses. You can't gain, but you could lose, and that you have insurance for. Speculative risks, like if you went to Vegas or anywhere, Atlantic City, you tried to gamble. Well, insurance companies will not cover you for insurance whether you're going to gain or lose, especially since government so much back up insurance companies. So speculative risk, where you have the potential to gain, is not insurable. But pure risk, where you only have the chance for loss, that is insurable. Now, the other concept for the rest of this video is just the 5 types of risk management techniques, and they do kind of overlap somewhat, but they're going to want to know that you know the names of these risk management techniques. So they are avoidance, reduction, retention, sharing, and transfer. And with avoidance, we mean a way that you avoid a risk. You just don't even take the risk. This can be, let's say a person's been at a bar and they've been drinking, and so they know they much rather would take a taxi or an Uber home than take the chance of having an accident on the way home. So they're avoiding that risk. Um, Maybe a bank chooses not to underwrite a loan to somebody because they've got really bad credit. So they are avoiding that risk. The second type is risk reduction. You see this at work a lot. Anytime you're doing preventive maintenance, you're working on things to detect the wear on parts before they actually fail. That's a way of reducing the risk. Putting in fire suppression systems. If there is a fire, then there's a suppression system that would reduce the risk, how much the fire would cost. Even wearing a safety belt when you're climbing to higher elevations, that maybe if you fall, but you don't hit the floor because the belt stops your fall, so it reduces your risk. That's risk reduction. Risk retention is where you still retain the risk yourself. This could be any kind of insurance policy. You have an auto insurance policy, but you have deductibles. So there's a portion of that risk you retain, even though if you have an accident, the insurance company may pay the rest beyond your deductible. Some companies actually choose to self-insure. So in that way, they retain the risk themselves. And then even a lot of people can't afford health insurance because it's $600-800 a month. So they just choose to retain the risk themselves, taking the chance that they won't get sick. There's risk sharing. That is when groups of people or companies get together and they will share the risk. Insurance itself is a risk sharing mechanism because it deals with large groups of houses, large groups of cars. Not everybody's going to have an accident or a fire that day. So everybody in their insurance premiums is kind of contributing to a pool that pays for one person's loss. Large companies can actually pool their resources to fund their own type of insurance. Workers' compensation can be funded in Texas, which groups of only large companies can do it, but the groups of companies can get together and say, we'll fund our own workers' compensation program. And then really the way insurance started was with ship owners out of England. If a person's ship was lost at sea, the guy owned the ship. He lost the ship. Well, he lost his ship. He lost all the freight. He's devastated. He's out of business. So the shipbuilder said, "Okay, let's pool our resources. If any one of us loses a ship, then we all pitch in to contribute towards that loss." So that's a form of risk sharing, and that's what insurance is about. There's also risk transfer, and that's a mechanism of contractually shifting the risk to somebody else. You can do it in contracts. You can transfer construction risk, say, to a construction contractor, or financing risk to somebody else. Insurance itself can be thought almost as a risk transfer mechanism. So those are the 5 types of risk management techniques. You should at least know their names. know the difference: avoidance, reduction, retention, sharing, and transfer. And just remember, when it comes to what's the difference between pure risk and speculative risk. Speculative is when you're gambling. You can have both a gain or a loss. That is non-insurable. Pure risk is where there's only a loss possible, and that is insurable. So this is my first. I'm going to stop sharing. That's my first clip video for you. We'll see how that works out. Thanks for listening.